All right, well, let's just go ahead and get started. Thanks for joining tonight, everyone. We're going to be going over recapping some of 2025 investment themes that we had, things we saw in the market, and what we are seeing going forward. But a little bit of housekeeping first. We're recording this webinar, so if you have to hop off or if you know somebody who couldn't catch us tonight, we'll be posting it on our website. We're going to try to keep it to an hour. If you have any questions, feel free to put them in the chat, and we'll circle back to them at the end. And with that, I think let's just go ahead and get started. A quick introduction. My name is Tanner Wrisley. I'm the CEO and Chief Investment Officer for Anchor Bay Capital. I started as our Chief Investment Officer in 2022 and have been running the portfolios since then. I got my degree in economics from Harvard and joined Anchor Bay 10 years ago. So have reached the decade mark with this company and looking forward to continuing to serving everybody on into the future. I also want to introduce Cory Large. Cory, why don't you give yourself a nice introduction?
Thank you, Tanner. If you guys have attended the last few webinars for either our investment strategy webinars or for our tax planning webinars, you might have seen my face before. I'm Cory. I'm also on the portfolio team with Tanner. I am a portfolio analyst and as well as a wealth strategist. So I also prepare taxes and do some tax planning as well. I joined Anchor Bay about 3.5 years ago. I went to undergrad at Northern Arizona University as well as Cal State San Marcos, where I helped run the student-run investment funds there, and then joined Anchor Bay about 3.5 years ago, where I've been working on the portfolio team as well as a preparer and planner on the tax side too. And I'm excited to show you guys kind of our outlook for 2026 and recapping what went well, maybe what didn't in 2025, and what we can maybe learn from it going forward. So without further ado, could you pull up the slides here, Tanner?
Yeah, let's get it going.
All right, so to kind of summarize the contents that we're planning on talking through on this webinar tonight, first of all, we wanted to circle back to last year, where there was definitely quite a bit of turbulence in terms of headlines and geopolitics, new administration, all these types of things, and kind of how they've affected market performance, not just from your typical indices like the S&P 500 or Dow, but also we want to look a little bit deeper into some more niche or obscure places that we can get some real good data from, like the equal weighted S&P 500 or the Russell 2000, which is your small cap company index. And then next, we want to dive into sort of the themes that we had set out at the beginning of 2025 and just recap how those certain themes did and how they played out. We'll talk about certain individual names that we had highlighted at the beginning of the year, certain industries that we had thought were poised for growth, kind of just give that recap as to how everything went. And then for the last bit of the presentation, we wanted to deep dive into some of the themes we're looking at for this year. We might see some similar strategy from 2025, but we also have some new research into new places that we feel are poised for growth in 2026 and beyond. So let's get it started here. Okay, so for the 2025 recap, we wanted to look at the yield curve, which is the 0 to 30-year yield curve of the U.S. Treasuries. And we want to see how that's changed over time. And looking at the yield curve, we'll be able to kind of see what might be the best place to go for our fixed income allocations, whether it be for treasuries or U.S. corporate bonds or for municipals, all different types of fixed income, and how we can analyze the yield curve to position for those changes. And then for the next part of this 2025 recap, we just want to show what the market did. And we're going to show you all different types of indices and different kind of benchmarks that we can look at and maybe take some clues from going into the following year. And then lastly, we really want to dive in and kind of do a big recap and kind of look at our track record for how we did with setting out our favorite themes that we're going into 2025.
Yeah, so we'll start with the boring stuff, bonds. I know everyone wants to go over stocks, and stocks can have a lot more upside, and they can be more exciting. Excuse me. But it's important to see where we're coming from in terms of interest rates, what the Fed is doing, and where we've been over the last year. Excuse me, sorry. Okay, so the red line here is where we were a year ago in terms of interest rates. What you'll notice is it's a lot flatter. We're talking about here, what are you getting from a treasury? On the very left is your shorter term rates. So you've got like a 1 month at the first line. I might even be able to get the laser pointer out here. So this is the 1 month treasury from a year ago. This is a 2 month, 3 month, and it goes all the way out to 30 years. You'll notice it's a lot flatter, meaning you're getting paid the same amount for locking up your money for, let's say, 1 month as you are almost the same for 6 months as you are for 7 years. And normally you would expect interest rate curves to go up and to the right. You would expect, if you're locking up your money, and essentially what you're doing with a bond is you're loaning money to whoever's bond you're buying. So in this case, it would be loaning money to the US government or the US Treasury Department. If you buy a 10-year bond, you would expect to get paid a higher interest rate than if you bought a 3-month bond. But while that was the case ever so slightly, usually there's a larger discrepancy between those two. And what you'll notice now with the blue line is there is that discrepancy. So this is what this action that we've had is what's called a normalizing yield curve. Normal yield curves go up and to the right. What's interesting though here is there is a little bit of what we call a belly. So it's higher, then it goes lower, and then it goes higher again. This is essentially the market trying to figure out where interest rates are going to be the lowest. So the market's predicting that we maybe get a few cuts sometime this year, and then sometime either next year or possibly in 2028 is when the cutting cycle ends, and then maybe we start to get some hiking. One thing I think that's really important to remember as well, interest rates, these are created by the market and the market's expectation of where interest rates go in the future. The Fed only controls this part over here. So if the Fed were to cut rates right now, you would see this drop immediately. But it wouldn't really affect the end portion of the yield curve. And you can see that's evidenced here by, even though the Fed cut a few times since last February, the long end of the curve really hasn't changed. And some important implications of that, like for banks and for us as consumers, we get paid on our money markets and our savings, our high yield savings accounts and CDs, and all of those things are at the short end here, whereas we take loans out usually at the longer end. right? Your mortgages are going to be at the 30-year end of the curve, or business loans are maybe around 10 years. So it's a normal dynamic where the longer end is going to be higher, but that has sort of been more pronounced recently. Um, so, what are we doing about this? How does this affect how we're buying bonds? We're usually going to try to avoid this belly of the curve, and maybe we're going to stick with some of these shorter term ones, shorter term bonds, and maybe do some of these ones over here that are where you're actually, the longer you wait, you're actually getting paid more for that waiting. So that's how we're going to be positioning our bond portfolios based on what the yield curve is giving us.
Tanner, I just wanted to mention one thing on the last slide, is that this is the treasury market yield curve. With the other types of fixed income like corporate bonds and municipals, it could look a bit different. And as a matter of fact, for the corporate bond market, it is more of a normalized yield curve.
Right.
And when we see interest rates get cut at the Fed, it's typically an indication that the spreads between interest rates with the Treasury and rates you can get with corporate bonds tend to widen. So something that we've been doing fairly normally is where if we can't get the yields that we want in that 1 to 3 year range in the middle, the belly of the curve of the Treasury, we've been going into looking at corporates that are in that time range, which have a maturity range, which have a more, an increased yield that we can tap into. And to keep it at a very similar risk level, we're usually typically staying at the investment grade credit quality of corporate bonds. So we're only looking at the highest quality companies when it comes to filling that time slot for fixed income. So I just
Great
wanted to
point.
mention that real quick.
Yep.
And so moving on to the more exciting part of the presentation per Tanner. We're going to start talking about how the markets did in 2025. And I really just wanted to illustrate a chart here of S&P 500, since it is typically the barometer of where people go to see how stocks are doing. Usually look at the S&P 500 or the Dow Jones. In my personal opinion, the S&P is a better barometer because that index is market cap weighted, meaning the top constituents of the S&P 500 are going to be the biggest companies that are growing the fastest. So it's a bit of a better barometer of how stocks are generally doing than the Dow Jones, because in the Dow they only have 30 holdings and it's price weighted, so it's a bit different characteristic wise. But anyways, looking at in 2025, you can see that markets did not move in a straight line throughout the year, for reasons that you are all probably familiar with. And pretty much from February until April, there were large spread tariffs, being talked about but not implemented quite yet. You can see once that talk was beginning, you could see in like the March to April range is when we started seeing some drops in the market, just because there's a lot more added uncertainty that we just weren't used to in previous times. And so what's happening when the market comes down based on uncertainty is that they're trying to price in different factors as to how it might affect corporations' balance sheets, income statements, and most importantly, future earnings. And so we did see a fairly large drop heading into April when the official Liberation Day came about. That's when Trump came on air and brought out that big poster board of all the different country tariffs. It was just a lot of unknowns being kind of thrown out for corporations, for consumers alike. And so there was a moment of trying to reprice where the market thinks that asset prices are going to go to. But to follow that back up fairly quickly, we did see a rebound post April again fairly quickly, because we have other factors at play beyond just what's happening at the geopolitical level. We have a lot of innovation happening in different industries, as you all have definitely heard of with artificial intelligence, with other parts of the market within technology. There's been a lot of developments where the market is really pricing in higher earnings for the next few years. And it has to do a lot with, we're going to potentially have a lower interest rate environment. Borrowing costs are going to be a lot cheaper for companies going forward if that does take place. It seems like throughout the year of 2025, there were active trade deals being negotiated, which kind of brought down some of the uncertainty of what tariffs might do. And so after that fairly large drop in April, we did see a very nice recovery heading into the rest of the year. And so kind of, parlaying that, Tanner will get into the next part here, but the entire market beyond just the top 500 companies wasn't the same when it came to performance and pricing and different things. So
Yeah, exactly. So just here are some raw stats. The S&P 500, which is that market weighted index, meaning it's giving a bigger allocation or a bigger weighting of the performance to the larger companies. That index, which is what everyone usually uses to measure the US stock market, was up 17.9%. So a great year again on top of a great year in 2024 and a great year in 2023. The S&P equal weight. So these are the same 500 companies, but let's say you gave them the same exact weighting in the index. So the largest company gets the same weighting as the 500th largest company or the smallest company. If you looked at that performance, only up 11.5%. The NASDAQ, which is more of a tech focused index, up 20.5%. And the Russell 2000, which is smaller companies, these are small cap focused companies, only up 10.8%. So, and there is some overlap between the NASDAQ and the S&P 500. And what we'll get into here is that discrepancy between the regular S&P 500 and the equal weight S&P 500 is because of mostly 7 companies that the market and investors so eloquently call the Mag 7. So these 7 companies, if you break out their performance, looking at the top chart here and starting back in 2021, let's say, here's the S&P 500 return, and you've got, okay, so 27%, great, in 2021. But let's pull out the Mag 7 versus these, basically what's remaining in the S&P 500 is the other 493. In 2021, the Mag 7 was up 40 versus the other 493 only up 23%. 2022 actually had a negative effect. That Mag 7 was down more than the other 493. Fast forward to 2023, massive discrepancy here. The other 493 only up 11%, but the total S&P up 24%, basically because this Mag 7 did so well, it brought the entire index up and essentially more than doubled the performance of it. This bottom column here, or the bottom row, the 63%, essentially says 63% of your gains for the S&P 500 in 2023 came from 7 companies, even though there's 500 in the index. So it just shows you the power that those 7 companies were having. And that continued on again in 2024 and in 2025, where the Mag 7 was really pulling a lot of the weight in the S&P 500. Now, was all this justified? These 7 companies keep increasing in terms of their stock price and performance. So does that mean that they're super expensive right now, or that they're unjustly overweight in the S&P 500. That's sort of up to interpretation. However, this graph does try to show you, um, does try to justify it in some ways. The lighter blue shows the growth of earnings in the Mag 7 companies versus the slightly darker blue is the other 493. So you can see the Mag 7 companies were giving you better profits. So in some ways you could justify that the performance should be better for those companies, because that's sort of what we're looking for when we're choosing to invest in a company is, what are you earning, what do your profits look like, and are you growing. So this is just, to illustrate the difference between the S&P 500 and what, I think people sort of take for granted. Oh, it's just a measure for the stock market. What it is becoming more and more recently is, it's becoming so tech focused, and really these large 7 companies um, are really driving a lot of the performance, and it makes it a little bit of a difficult, um, I guess, a difficult measure, or it's not, in my opinion, doing a good job explaining the American stock market. It's really just explaining more and more just these 7 big tech companies.
Right. And there's a lot of talk about, okay, so we've seen Mag 7 outperformance within the market for the last few years. What could possibly make that, switch around? And so something that's really been in focus for the last few years, and you can really tell from this chart here, is that we've seen a much higher CapEx spend from the Mag 7 names. And CapEx spend can mean quite a bit of different um, implications. And so one of the more popular talked about CapEx items for these big 7 companies is building out data centers, is buying NVIDIA chips, buying other types of semiconductors. All of those different spending items that these larger tech companies have are considered capital expenditures when you're reading a financial statement. And as you can see, from 2023 on, we really have seen exponential growth of the total amount of CapEx from those bigger tech companies. And like I said, it's a combination of data center construction, buying semiconductors, signing agreements with utility companies, doing all these types of things, permitting, that allow them to expand their operations and to invest more and more into what they consider is a high ROI, or a high return on an investment that they can make in order to grow their businesses. And so when we're really talking about, can the Mag 7 continue to outperform the rest of the index for some time? The answer is, possibly. I would say a factor that would kind of um, put a needle in that is if CapEx spend becomes a bit too much or a bit too worrisome in the eyes of investors, and maybe the profitability of artificial intelligence isn't quite there for these companies, and that investors might view it as a bit too much of a ambitious and uncontrolled spending. And so in my mind, in that scenario, you could see a bit of rotation out of Mag 7 back into 493. And now I have, Tanner and I have both seen that, there has been a bit of a stall for a couple of these companies, such as Amazon, Apple, Meta, a lot of these companies which have been spending a lot of CapEx and haven't been seeing immediate return on that spend. It is kind of getting weary in the eyes of investors. And to the start of this year, we've seen outperformance from the smaller companies and from industries that aren't exactly related to this AI theme. So I just really wanted to illustrate, why there's been a lot of attention on this industry and on this innovation, and it's because these companies are spending hundreds of billions of dollars to make it work. And like I said, it's a combination of things. And if we do see this capex slow down, it could be a signal to investors that maybe it is time to look at different parts of the market to get more attractive valuations, to get growth at a reasonable price, things of that nature. And so we're constantly looking at that, analyzing whether it's time to start looking to other places. But for the meantime, the Mag 7 is still the biggest companies in the US and honestly, biggest companies in the world, and for a good reason. A lot of these companies have core businesses which are extremely profitable, cash cow machines, and they have the ability to spend this type of money because they just have hordes of cash that they can really burn on projects and internal things that a lot of other companies couldn't do. So we'll keep an eye on this capex figure, but it has been growing exponentially, and it could be a signal in the future for investors and whether we should rotate out or look at other places in the market. So
Yeah. And I'll just make a quick note too, like what we are doing in our portfolios. Are we piling in? Are we ignoring these Mag 7 companies? It's going to be somewhere in between, somewhere in the middle. We want exposure to them, but not at the levels that the S&P has. I think the S&P has a weighting to Nvidia of something like 9%. It's just a weighting that we're not comfortable putting into one company, because if something happens to that company, it could dramatically affect your portfolios. And so we want to stay more diversified. Yes, we want exposure to these, but at more moderate, modest levels.
mhm.
Okay, here's a very interesting thing that we're finding, theme that we're finding, and this was happening in 2025 and previous years, infrastructure spending. Um, but there's some nuance here that we think is important, and we'll circle back on in later slides as well. If you just ignore the different colors and you look at the total bars here, it shows you how much spending is essentially going to be needed in each of these areas of infrastructure. So roads and power and water seem to be the biggest areas of concern. But what's really interesting to note from our end, there's been a lot of talk, I think, recently about power generation, and the market has rewarded certain companies for being part of that beefing up of where are we going to get power um, to power these data centers, or everything takes electricity. So, we know that we're going to need more power than we've had in the past, and how are we going to produce it and do it cleanly and all of that. What is very interesting to me and to Cory and I is this water section, which we don't feel like has been talked about a lot.
Mhm.
And I'll point your attention specifically to the difference in this darker section versus the lighter section. The lighter section is much larger for water than any of these other areas. And essentially, what it's saying is here's what has been planned slashed announced. Um, and you can almost think of it as been priced into the market, versus the lighter blue section, which has not been announced, but we know we're going to need. And essentially, in our mind, is saying this is the biggest opportunity that has not been priced into the market. So we'll have more information on water and water infrastructure later, as that's going to be one of our themes for 2026. But just an interesting breakdown between different areas of infrastructure and the opportunities therein. Um, I did also want to remind people of this change that we've seen in public versus private companies. And I think whenever someone thinks of investing in a company or a stock, they're thinking public. And generally, I think most people think, oh, all the big companies are public. Well, that's actually not true. And a good majority of companies in our country are private companies. Um, you can see here 86% of essentially revenue generated in the US was generated from private companies. Only 14% is public, which is a lot lower than I think people would think. If you look at the different shades here, let's just say, for example, the darkest shade. These are companies who have generated more than $1 billion in revenue. Um, well, this shaded portion is actually just as big as this shaded portion, meaning companies generating more than $1 billion in revenue, there's just as much, if not more, that are private than are public. Um, and the industry has been changing a little bit to make these private investments more accessible. We did a webinar last year on alternative investments and private markets. And so, if that is something that is of interest to you, it's something that we are looking to start implementing. And so, if you know, if you want to have a conversation about if private markets are right for you, they're still not right for everyone because there are some very limiting factors to them. But in a lot of cases, they can provide a really good addition to your portfolio. So you may, in a meeting with me or one of your advisor, hear us talk about private markets and alternative investments. And this is one of the reasons why their private markets are becoming more and more, I would say, commonplace in people's portfolios. Okay, so now on to that was the 2025 recap for markets. Now we're going to talk about our sort of active positioning recap for 2025, meaning last year in 2020, early 2025, when we had a similar webinar, we talked about three specific areas or themes that we felt were poised for growth, that we wanted to focus or overweight our allocations to in terms of our clients' portfolios. And I would say largely these were all home runs. This is not cherry picking. These were actually the three areas of the market that we put in our early 2025 webinar, investment webinar. So I'm just going to go through each of these. Aerospace and defense. So this was, if you recall, President Trump, now President Trump gets elected in November of last year. There was a lot of talk in the beginning about cutting the federal budget. There was talk of Doge
Doge.
and what they were going to do to limit spending in the government. And there were a lot of things getting swept up with selling because of those worries. And some of the companies that were some of these defense names. And we sort of wanted to call the bluff on that and say we don't think that the new administration is going to limit spending in that area. And essentially, we were correct. These names that we have in here, these are tickers of stocks that we have and that we've held in our clients' portfolios for 2025 in some way or another, and their performance in 2025. So largely home runs. Even Lockheed was still up 4%. I should clarify that the laggards mean they're below their sector average,
Mhm.
but they may still be positive, like Lockheed. It was up 4%, but behind maybe the average defense company. The rest of the names that we had outperformed essentially. We didn't expect them to be that great, but it was definitely a good call to sort of see through what was going on with Doge and think, you know, given the administration and what they did last time, we felt like defense and aerospace was a good place to go. The number two here on the list, second order AI beneficiaries. So this is just meaning, yes, we bought into the AI boom. We didn't want to do that by investing in startup AI companies, but investing in companies that were sort of the picks and shovels of the AI revolution, right? Um, Lamb Research is an example. They make machines that make chips. So they're sort of that's a great example of second order where they're like behind the man who's behind the man,
They're a few
right?
layers deep.
Yeah, exactly. And they have a lot of different companies and customers that they have. I'll specifically point out Seagate, STX, this up 225%. And I think it's a good example for me to explain. Not all of these companies were in all of our clients' portfolios. Different strategies and different risk levels and different life circumstances call for different types of investments. And we are highly customized to what are our clients' goals, how comfortable are they with risk, how long is their time horizon. All of those things go into deciding which types of companies go into the portfolio. And Seagate, even though it was up 225%, which when we put it into the portfolio, we never expected a return like that. Obviously, we will take it. Um, it was actually not in our most growth oriented portfolios because we profiled it as it provided decent income, some stability for it being in a tech focused industry, and good upside. Obviously, the upside played out way more than we expected, but that's just an example of one stock that was in our clients' portfolios. But again, not all of these, you may have seen these in your portfolio, but not all of them are going to be right for everyone. I'll just talk about the laggards here briefly. A lot of these are software names like Salesforce and Adobe, down 21% last year. This was sort of surprising to us. We felt like those companies were going to be well positioned for growth as well, like last year, but didn't pan out that way. We still feel generally positive about them. However, there has been a lot going on with software in the news. Recently, you may have seen some of the worries about companies that are in the software industry, and AI essentially taking their jobs now. So I would say our feeling on this is generally one that the market is overreacting to right now. We feel like these things happen slowly. So if there is an AI takeover of a lot of the software processes that companies and individuals are paying a software company for, that the market is now thinking, well, maybe AI can do that instead. We feel like at least at the very least that process will take a long time to sort of play out. And what we see a lot is the market sells and then it's sort of like a sell now, figure out the real impacts later. And I think that we're in that stage right now. We're still in the sell now stage of software. So there may even be some buying opportunities here when the market comes back and says, okay, we don't think that, we overreacted and we think that there's, actually going to be some play here for these software companies. But right now, they are sort of selling down a little bit, even though they have historically been some of the best companies and best performing companies in the US stock market. Lastly, I'll move on to our third theme, which was financials, banks, capital markets. So our theory here was, and sort of still is, generally positive with the way interest rates are presenting, and with some of the shifts that we've seen um, in the way people invest, and some of the assets that people hold. Speaking particularly on banks, I sort of started to touch on it in the beginning when we were talking about interest rates. Imagine if you're a bank and you're getting to loan out mortgages and business loans at that longer end of the curve, where you're getting to charge your customers higher interest rates. Well, what are banks? Um, what are banks' expenses and costs?
On
There are
short end.
things like CDs, and there are things like paying yield on savings accounts, and they are, yeah, high yield savings accounts, money markets, things like that. Those are all tied very closely to the short end of the yield curve. And when things normalize, you get a low short end of the curve and a high long end of the curve. And essentially, what's happening right now is their costs are going down and their revenues are going up. So that has led to a lot of outperformance within banks. And then capital markets, a lot of investors are getting more sophisticated, using more things like private investments, let's say, as an example. Um, More people are getting access to investing. I think Robinhood was a big player in this, which just where investing used to be for the rich, now it's just for everybody, which is great. And there's more people using these types of capital markets to invest and hold their assets. And these companies that sort of facilitate that are getting to benefit from it. And so you're seeing a massive growth in terms of how much those companies like Schwab hold, or um, JP Morgan hold, in terms of their assets that they're managing for people. So um, generally, these were the three areas that we targeted, and I would say, again, they did really well in our view, better than we could have expected, really. um, in terms of, these were the places that we wanted to overweight the most.
Mhm.
um, yeah,
Right.
go
And I
ahead.
think this is a great explanation as to why diversification is extremely important. And you can find very attractive returns in places that might not be very suspecting. I mean, you see a lot of names in here that are in traditionally boring industries that, in large, outperformed the overall market because there might be new durable trends that are taking place, whether it's a societal trend, whether it's a trend behind geopolitics, whether it's a trend of where the yield curve is moving. There's lots of different areas that you can kind of dig into and research to see, maybe there could be a bit of a rotation out of the most popular names. And maybe there are multiple layers to, these brand new innovative technologies that are coming out, like AI. You can see there's semiconductor names, utility companies, Caterpillar, which is what everyone knows as the construction machine company. Um, they're seeing exponential demand because to build all these data centers, what do you need? You need massive machines to move the earth and to help bring a lot of this power together. And so it's just really important to be very aware of different parts of the market, even if they're not, traditionally very popular places to go. And as you can see, we went to different themes that are either long-term in nature, like defense companies. They're going to see much higher and increased long-term contracts with governments. And you also have some shorter-term plays like the financials, when we're looking at the yield curve more and seeing who might benefit most to these shorter term shifts. So all in all, I think diversification is extremely important, and to make sure that you're looking into parts of the market that may not even be as popular for most investors. So I think, like Tanner said, we did a great job of trying to identify these different themes before the bigger crowd caught on. So um, we have some other exciting places we want to look as well going forward. So we'll get into those.
Yeah, so for this year and just how we're positioning things going forward, I touched on it earlier. Water infrastructure is going to be one of our themes. We saw that slide, which basically showed there's a lot of unannounced or unplanned spending that needs to go to this area of the economy that has not yet been put in place. And when you look at the companies that would be um, set to benefit from that type of spending and how they've done in the past or recently or last year, a lot of them have not seen much run up yet, which makes us excited, thinking that this could be a really good place to go and to position portfolios for the future. Um, Many of the water systems in developed countries, and especially in the US, were built in the 20th century. Um, so I think I was reading a lot of our pipes in the US are 50 to 100 years old. So this deferred maintenance has created sort of a backlog of upgrading that needs to happen, and it sort of needs to happen in a hurry. And that's just maybe on the drinking water side. Um, Another massive part of this water infrastructure is that it's essential to energy production. So water is needed to cool in the power generation process. Many renewables like solar need water cooling as well. And so it's an essential part of what's going on with the AI revolution and all of the power that people are talking about we're going to need. We're going to need water with all of that as well. Um, and the big one here is this can be a bipartisan issue. You know, there are a lot of things that you can sort of point to on one side of the political spectrum or another. But having clean water and having power tend to be two things that are should not hit a ton of roadblocks in terms of if they were to create some sort of an infrastructure spending bill and have the government pay for some of these upgrades. Um, we do think that there could be some private or some market or some companies that are spending in this area, but the big windfall would be if a massive infrastructure bill was spent and a lot of these water infrastructure companies got swept up in it. We listed a few companies here. Um, these are companies, I guess, that we're looking at, but I wouldn't say that they're necessarily ones that you want to jump right into immediately. There are other things that are at play here, but at least they're in the right industry. Um, I'll just highlight a few of them. Xylem is a sort of a pure water infrastructure play. Badger Meter does the meters that measure how much water is going where. It's kind of interesting that there's all these little niche areas within one area of the economy, and what we like to look for is there a company that sort of has a stranglehold on one part of that process where if water infrastructure becomes a big part of spending going forward, is there a company that is going to be integral to at least one part of that? And so that's sort of where we're going to look to try to position ourselves. Okay, so number two here, the electrification economy. As I said, much of the last couple of years has focused on energy production. So let's play that out and say, okay, we've produced all this energy now. What do you do with it? It doesn't just magically get to a data center or get to your house. So it has to be moved, it has to be stored, it has to be harnessed. Um, these are all things that we're going to need to upgrade in order to keep up with the energy demand. Essentially, we've been focusing on power generation. I would say us as a society and even investors. Lots of companies that are generating power have seen big upgrades or big price increases, and this new generation capacity is essentially growing faster than the transmission needed to carry it. So there's a transmission sort of capacity bottleneck where our power lines and transmissions are going to be overloaded if they're not upgraded to the newest technology and the newest cables and all of that stuff. So we see this as an area that again has not been focused on as much by investors. Investors have sort of focused on the power generation portion. um, so we want to focus on, okay, you've got the power. Let's say you've got the power. How do you get it to where it needs to go? And picking certain areas along that process where if we can find a company that has, again, is a market leader in some part of that process, that's the type of company that we want to look for. Um, Again, this is a bipartisan issue as well. So this whole energy build out, um, I could see something like this, some sort of infrastructure bill getting passed in Congress and through our government and legislation written that would see a lot of companies in this electrification economy getting some of those funds.
Yeah,
Um,
I would add too, from the last administration, there was also a bill passed, called the infrastructure bill, and a lot of these different areas were addressed, but not in the type of demand that we're now seeing these days, in particular because of these new innovative technologies that take a lot more electricity to bring to life. And so, like what Tanner said, what could be a very likely scenario is that we take what we already have with the past infrastructure bill, which again is trillions of dollars. It's not a small bill, but to meet this heightened demand, and to make sure that we can transport water and electricity in a way that is beneficial to both companies and to consumers alike is a very bipartisan issue, and we think that there is a very likely case where we do see a piece of legislation passed that is address, digging power lines, upgrading infrastructure that's decades, if not centuries old. A lot of these things in our minds could be a very likely scenario to be passed.
yeah.
And it's agreed upon both sides of the aisle. No matter who you are, no matter what side you're on, you need shelter, you need power, and you need water. And I think that's just there's more likeliness of something like that of that magnitude being passed if both corporations and consumers alike are both in demand for it. So
We've got 5 minutes here, but so we're going to run through these last. We have two more themes here. De-globalization impacts. So, what we're talking about with de-globalization is if the US is taking a more insular economy, insular economic stance, meaning we're placing tariffs on other countries and we're essentially saying we want to start manufacturing things ourselves that we used to just import from other countries, or at least make it sort of harder on other countries to import to us by putting a tax in the middle of that process. Right? That's where we are currently. Um, this will have sort of a ripple effect onto the geopolitical sphere, as you might imagine. that can create tensions, right? If countries are used to being able to sell to a U.S. consumer, and now there's something interrupting that, like a tax or a tariff, that can create tension. The other thing is more of a longer term implication is a lot of countries, let's say, have relied on the US consumer for a big portion of their economy. Now imagine a scenario where we've essentially taken over manufacturing of that thing that that country was exporting to US consumers, and now they're not exporting to the US as much. Well, before they used to be pretty dependent on the US economically, which would maybe prevent them from wanting to make the US mad in the geopolitical sphere. If they're not as reliant on the US anymore, um, maybe it leads to more brash action in the geopolitical sphere. And this is all leading up to, if you're going to deglobalize, you also need to spend on the defense side of things. So now we're right back to where we positioned in the beginning of last year, which was in that aerospace and defense area. There are, in this time, it's not only in the US, but it's also globally. We do feel like there's going to be continued spend in defense if countries are now going to be essentially, um, there's going to be economic walls built up. Then there's also going to be some other defensive mechanisms that are going to be in place to offset that. So, and another thing, reason why we felt like aerospace and defense might do well last year as well is because in Trump's first term, he established the Space Force. Um, that's sort of his baby, right? We felt like he wouldn't have any problem sending some funds to that area of the defense budget, and that turned out to be the case. They have seen some windfalls, and so we expect that to continue. It certainly doesn't hurt. So companies like L3 Harris, their satellite company, or Howmet, um, that are in defense but also in space, we love. We feel like those are great places to be. Um, and then the last theme has to do with aging demographics. And this sort of can ripple out into two different areas of the economy. Many financial implications to an older average age population. Um, as people are living longer, there's increased healthcare costs and sort of assisted living needs that are associated with that older living. So you think of there's companies like Welltower, which is a real estate company that their tenants are assisted living and skilled nursing facilities. We view this as a an area of the economy that we think should do well. There's also a large transfer of wealth to younger generations. So if you think about, older generations have um, lots of, let's say, money in the bank or real estate or businesses. When this gets transferred to younger generations, what we're seeing from younger generations is a lot of assets or investments that are more financial market focused. So, not a lot of the younger generations buying real estate, but buying crypto or stocks or
Prediction market.
private markets, these kinds of things that are um, run by capital markets, right? They're run by institutions rather than, you buy real estate, you sort of own it directly. You buy private market, PE, private equity, or you buy a stock, or you buy you buy Bitcoin. These are all done through exchanges and through capital market companies and banks and things like that. So that shift, that transfer of wealth from just the way that different generations have invested, we think would see a windfall towards these capital market companies. So, like Charles Schwab, which a lot of you are familiar with, CBOE is an intercontinental exchange. Are both exchanges. Intercontinental Exchange is essentially the New York Stock Exchange. We see those companies well positioned for this sort of aging demographic theme. In addition to the more maybe obvious ones like HCA Healthcare, which is a hospital and urgent care and outpatient surgery centers and things of that nature. So that is the end of our webinar. If there are any questions, we'll take a look at them right now. But just wanted to thank everybody for joining tonight. If you have any questions about your portfolios, if you're not currently a client of Anchor Bay and you have questions about how we do investments, or you have questions about anything that we went over in this presentation, but you don't want them addressed to the group, we can certainly facilitate any of those questions. Feel free to reach out to us. Cory and I's emails are just our first names at anchorbaycapital.com. So mine would be Tanner at anchorbaycapital.com. You can feel free to shoot me an email or call into our office 760-602-3470, and we can certainly address your question. But for now, let's see if we have any questions. Not seeing much in the way of questions right now. I do see some thank yous. I appreciate that. All right. Well, thank you everyone again for attending. We'll get going here and wrap up. I think we'll have another webinar. We may be skipping due to tax season, the March webinar, but I believe we'll be back with another presentation in April. So look out for our newsletter. We'll continue that through tax season, but hope you all have a very nice Wednesday night, and we'll talk to you soon. Thanks.
Thanks, everyone.